So what we are doing here is the consultation, a series of events as part of the consultation for the climate change strategy draft. So we want the community's feedback on the strategy itself, on the targets, the emissions targets, but also all of the goals and the pillars and the strategic area. We really want to hear from everyone who's got thoughts about this, how we can improve it and reflect your vision into that community strategy. We are seeking sort of feedback, and there is, if you go onto the Shape Nelson website, there is a little button that takes you to either a submission form, or also a survey, because that helps us understand how is the community thinking about climate change. All right. So this is one of the series of talks we are doing. This is the third one. And there will be more. This is the list of the talks, so I invite you to look at that. You can also grab some flyers to see what's happening. And there is also, the last thing, there is also some panels there, some questions and post-its if you want to just put your thoughts directly here. That is also extremely helpful for us. All right, so I'll briefly give some context for Jonathan's talk, and then pass it on to him. And so Jonathan Boston is Emeritus Professor of Public Policy at the School of Government at Victoria University of Wellington. Climate change policy, both mitigation and adaptation. That's one of his research interests, as many others. He served during 2022-2023 as a member of the expert working group on managed retreat for the Ministry for the Environment, and assisted the Environmental Defense Society with their project on climate change adaptation. He's published some books as well, and some recent books include Safeguarding the Future, Governing in an Uncertain World, and A Radically Different Planet, Preparing for Climate Change. All right, so Adrian, if you want to click. So maybe we'll start, why adaptation? So adaptation is a global issue, so what matters is the global emissions. So if we look at this and the concentration of carbon in the atmosphere, so it has just kept increasing, and it just keeps increasing, and that means the more time passes, the more pressing it becomes to discuss adaptation and start making plans, while still it's absolutely essential that we reduce our emissions here, even if we contribute very little to the global emissions. We still have a responsibility towards ourselves, our children, grandchildren, and future generation, as well as all life on Earth, really. And just a little note in passing, if you look at the grey line, the tiny little dent at the end was COVID. So the emissions globally reduced by 4% during COVID. That gives us just a rough idea of the sort of changes we might want to see. We don't want to lock people in, but it just gives us an idea of what it takes to reduce our emissions, and then we worked really, really hard to get our economies back up and running, and so emissions went back up again. Yeah, one more. So this is, oh sorry, one back. Yeah. This is something that is in the climate change strategy, so sorry, it's a bit small, but it just gives us an overview of the sort of direct and indirect impact we can expect in the region. In a nutshell, we'll see average temperature rising, atmosphere and ocean. Our seasons will shift, and lots of more extreme events, more frequent and more severe. But mostly we'll see as well a lot of variability and volatility in our weather, which is kind of really problematic for both the management of our assets, but also for the natural world. Thank you. But something we've got to think about as well is that it's not only local, the impacts of climate change and what we're going to experience, it's what's happening elsewhere. There is more and more research that is being done on what we call transboundary climate risk, and trying to understand how the impacts elsewhere will start to trickle all over the place. And it will affect pretty much everything we do. The resources we have access to, whether it's terrestrial resources or ocean, agriculture and food security, our industrial supply chain, our energy supply, the financial sector, of course, gets really affected by all the extreme events and ongoing pressures, infectious diseases, human mobility, livelihood and well-being. So it's a pretty grim list. But the good news is we are starting to understand a bit more about these, and this is something locally we will need to be doing as well, trying to understand those. The second, what we're going to talk today about is the impact of the direct impact and insurability. So we all have images in our minds about what's happened in North Island in 2023 and then in Nelson 2022. So I apologize for the people who've been here a couple of times and have heard me go through this, but I'll do it again. So the flood events in the North Island, Hawke's Bay and Auckland cost New Zealand between $9 and $4 billion, depending if we count the flow-on effects of these events. And in Nelson, $77 million for the floods in 2022. That's a lot. If it happens too often, it may very well drain our financial resources and our ability to anticipate effects and spend money on adaptation. And I've heard someone say that not too long ago, if you don't know your climate risk, trust that your insurer does. And that's very true. Insurers, that's their business, so they know very well what's happening. And so what's really crucial to understand for us and our community is that we also need to understand our risk and show the insurers that we are taking action to reduce those risks, so they don't withdraw and they don't panic, and they know that they're trusting that we are doing something about it. Just an image here. These are models that were done for Hawke's Bay, for Napier. And this is a model for a 100-year event, so 1% chance of this event to occur. This is what happened. So the models are fantastic. We do need them to start planning, but they are also imperfect. We can't account for all of the factors, and this should really stay in our mind when we do planning and not reject the extreme scenarios that are becoming more likely. So those, we call them the high impact, low likelihood scenarios. So we must keep them in mind every time we plan. And that's it for me. So Jonathan,
fantastic. Can we just stay on that slide?
Yeah.
Just for a moment.
The previous one?
Yes. So this is Taradale, and as some of you will be aware, had the situation been just very slightly worse, and had the council not invested in upgrading the stop bank along the relevant river here, and I can't remember which it is, much of Taradale would have been underwater as well. As it happened, only a small amount of Taradale was affected, but that would have done an immense amount of additional damage. So it was, well, good planning in the sense of improving the stop bank, and good luck that it wasn't just a little bit worse.
Yeah.
But that's a pretty dramatic.
It's a pretty shocking image.
Yes,
really.
And much of the housing that was affected in this area is relatively new. So it highlights one of the problems we've got, which is the continuing development of areas that are risk are flood prone.
Yeah.
Yes.
All right. Thank you, Jonathan.
Thanks, Marie. All right. Okay. Well, look, Marie, thank you for the opportunity to contribute today. I've got some slides which I'll go through. If you could just move to the one which has the outline. Thank you. So what I'll do is just make some summary points that will give you a sense of an overview of what the slides cover. And then I'll work through some of the topics in just a little bit more detail. Since it's a small group, please feel free just to interrupt and either offer a comment or a question as we go. We can be very informal about this. By way of background, just to say, I'm not an insurance policy expert. I know a little bit more about it now than I used to. During the work of the expert working group on managed retreat, it became clear to me that insurance issues were fundamental, and that if we were going to think about managing what's coming at us from the future in terms of increased flood damage, sea level rise, coastal inundation, and so on, we would need an integrated strategy involving better land use management, better risk assessment, increased protection where it's cost effective to protect vulnerable communities, relocation where it isn't cost effective to protect vulnerable communities, but some mechanism for maintaining accessible and affordable insurance. I encourage my colleagues on the expert working group to devote a chapter in our report to insurance, but it wasn't in our terms of reference, and we ran out of time. So that was unfortunate. However, subsequent to that work, the Helen Clark Foundation, with the support of WSP, somebody from WSP here, supported a project on the future of residential property insurance, and that report I helped with last year and was published under the title Premiums Under Pressure towards the end of last year. So that's a document that's readily available. The other thing, just as a citizen and as a property owner, I'm very conscious that insurance premiums have been going up very substantially in recent years. My own, well, the house that my wife and own in central Wellington, the house and contents insurance has gone from $2,000 a year 3 years ago to $6,000 a year this year, so a tripling. And our house is not in an area of high risk other than earthquakes. We're on a flat section, no risk of landslip, no risk of flooding, no very limited risk of fire, and certainly no risk of inundation because we're probably about 30 or 40 meters above sea level. So, Wairoa, many areas of the country, as you know, suffered very significant flood damage during 2023 in particular, but floods of this kind, of course, are going to become, unfortunately, more common as the climate system changes over the coming decades. Next slide. In terms of references, can I just draw your attention to a couple of things here? David Middleton ran EQC as the chief executive for many years, and he's published quite a number of really interesting papers. So anyone here really interested in insurance issues, I certainly recommend you have a look at anything that David has written. Belinda Story is one of our experts on insurance. She was on the expert working group with me in 2022, 2023, and she has published an excellent article with colleagues in a major international journal called Climatic Change, and I'd certainly recommend that particular piece. For those of you interested in more philosophical issues, the piece by Lawrence Barry called The Moral Economies of Natural Disasters, Insurance, Solidarity or Individual Responsibility, and I'll talk a little bit more about this. Really interesting piece and recommend that. But there's lots and lots of material. Next slide. Okay, so let me just quickly summarize some of the really key points that we need to be aware of. So first of all, New Zealand faces multiplicity of natural hazards. We are one of the most vulnerable parts of the world in terms of natural hazards. We are vulnerable to pretty well every natural hazard: seismic, climatic, tsunamis, etc., etc. And indeed, if you look at the data over the last 60 years or so, New Zealand comes second to Chile as the country which has suffered the most significant damage as a proportion of GDP of any OECD country. Averages out at around 0.6% of GDP over the last 60 years or so, second only to Chile, which of course is also on the Ring of Fire, the Pacific Ring of Fire. We have, as you know, what's called a protection gap entity, PGE, in the form of what is now called the Natural Hazards Commission, probably known to most of us as EQC, or the Earthquake Commission. And we've had that body for the last 70 or 80 years, since not long after the Second World War. It was established to address the problem that in many parts of the country, and particularly Wellington, property owners couldn't get earthquake insurance. And so there was a protection gap, and the government established the Natural Hazards Commission. There are similar bodies to the Natural Hazards Commission all over the world, and I'm happy to talk to you about some of those in due course if you're interested. Key problem with the Natural Hazards Commission right now is that it covers most perils, but not flooding and not coastal inundation. Yet those are the problems that are going to become more evident and more serious as this century progresses. Internationally, most of the PGEs, or protection gap entities, do cover flooding, at least to some extent. Not coastal erosion and inundation necessarily, but certainly most inland flooding. Well, as you'll be aware, climate change related risks are bound to increase, as Marie has indicated, both globally and locally. And so we're going to be faced with more property damage, and where those properties are insured, obviously larger insurance losses. And that is going to stress insurance companies, but also reinsurance companies like Munich Re and Swiss Re. Sea level rise is going to become an increasing challenge for coastal property owners over the coming century, and ultimately will replace what's called pluvial and riverine flooding as the main source of, if you like, water damage as the century progresses. At the moment, most damage which is water related is from flooding, riverine or pluvial, but over time sea level rise will become the dominant cause of property and infrastructure damage. And just on sea level rise, the last 2 years have witnessed a dramatic increase in sea level rise. We've gone from an average of around 0.37 centimetres per year, or to put it differently, 3.7 centimetres a decade, to 6.5 centimetres a decade in the last 2 years, 2023, 2024. And if that was to continue, and it's very likely that it will, and indeed accelerate, well, we could readily have an additional 20 to 25 centimetres by 2050, and substantially more as the century progresses. So, as I've indicated already, property insurance premiums have gone up recently, creating more issues of affordability, and also insurers are beginning now to think very carefully about whether they will insure high-risk properties. So we're almost certainly going to have not just increased affordability issues, but also increased availability issues for property insurance, be it residential or non-residential. And as I've indicated, insurance retreat, coupled with the retreat of financial assistance from banks and so on, will almost certainly gather momentum. Next slide, please. Now, in my view, maintaining high insurance penetration or insurance coverage through ensuring that it's affordable and available is really, really important if we're to retain a relatively resilient society and economy. If people can't get insurance, and increasing numbers of people can't get insurance, then when natural disasters strike, obviously people will then be forced to take the losses themselves. That will increase bankruptcies, it will increase psychological stress and other health-related issues. It will make it more difficult for those people to resume a kind of normal life, and that will increase costs to society as a whole, and indeed costs to the government in terms of additional fiscal costs and so forth. So we need to do our best to ensure that we have a resilient economy going forward, and insurance is a critical element in that. We certainly need more robust risk information along with proactive adaptation over the coming years. Amongst other things, we need to ensure that we are not developing additional housing areas and business developments in areas which are going to be flood prone or prone to sea level rise. So, in other words, we've got to seek to minimize future risk by sensible development of housing and so forth. But, of course, while we can seek to reduce additional risk, we're nonetheless faced with a lot of what is often called legacy risk. This is where existing properties are. So a critical issue is going to be what we do in relation to the management of that legacy risk. in my view, and I'll outline some options here in more detail in a minute, we will need to rethink our insurance arrangements in this country at the national level, in the regulatory sense, as we confront these significant additional risks from climate change. And there are really two broad options available. One is a greater reliance on markets and individual responsibility, and the other is a greater reliance on mutual responsibility with collective risk pooling, community-based premiums, and so on. Both options have advantages and disadvantages. There's no, if you like, free lunch here. It may be possible to combine elements of those two options. My own personal preference is that we place more weight on mutual responsibility, and I'll outline some of the reasons for that shortly. So that's a sort of quick summary. Here's a figure showing the increase in residential insurance prices until early last year. Things have gone up even more since then. So the black line is the dwelling insurance price index. Data here from the Reserve Bank of New Zealand in May last year. The blue line is the construction cost index, and you can see that construction costs have gone up quite significantly as well, which is one of the reasons that premiums have gone up. And the red line is the consumer price index, which has also gone up, but not nearly as much as the construction cost index and the insurance price index. So those of you who own private property and have experienced significant increases in insurance premiums, well, you're in good company at the moment in terms of what's happening nationally. Okay, next one. In relation to what are called these protection gap entities, PGEs, as I indicated, many countries have them, but they differ in all manner of respects. I'm not going to go through all the details here, but simply to say there are a variety of ways in which you can design your institutions at a national level to address major natural hazard risk. And different countries have adopted different models. There are some, if you like, different versions of these models around the world now. One is the Flood Re model in the United Kingdom, which I'm happy to talk to you about if people are interested. Another, which is common in Europe, is the catnap scheme in France, and similar versions of that elsewhere. You have in the United States the National Flood Insurance Program, which I would not strongly recommend. Happy to say a bit about that if you're interested. And then more recent developments such as the cyclone pooled reinsurance entity in Australia. But we can come back to some of this later. Next slide. All right, this just gives you a quick snapshot of some of the PGEs around the world, drawing on work by David Middleton. Most of them rely on levies on private insurance arrangements to cover their costs. In some cases there is government funding. In the majority of cases there is a government guarantee. So if the Natural Hazards Commission runs out of money, then the central government here in New Zealand steps in and provides the difference, as it did, for example, after the Canterbury earthquakes 12, 13 years ago. Next slide. All right, so as we think about the sort of future of residential property insurance in New Zealand in the light of increased climate-related risk, as I've indicated, there are a range of options and with many permutations and combinations. Two broad options, which I've already indicated. A key issue is going to be how do we best address increased flood risk and coastal inundation. In my view, building on the Natural Hazards Commission would be one option, and I'll say a little bit more about that shortly. But whatever path we take, we need to minimise new risks, as I've already indicated. And amongst other things, we need, in my view, a really good, robust public debate about these sorts of issues nationally. And ultimately, we need some kind of multi-party agreement on the way forward so that we have stability in the policy sense, and people can have a sense of security going forward. Next slide. Okay, so what I want to do now, just briefly, unless there's any quick questions at this point, no? Okay, is to run through two rather different ways of addressing what is coming at us from the future in terms of future increased flood risk. Yes?
Can you just explain what the gap is with flooding? Because private insurance on dwellings does cover flood damage to your house, doesn't it? Like, where's the gap sit?
Right, so when we talk about a protection gap entity,
Yeah.
these are entities that have typically been established to address catastrophic risk from major natural disasters, which might be a cyclone or a major earthquake or a tsunami or whatever that can occur from time to time around the world. And the evidence over the last 100 years or so is that there are certain types of big events that insurers, private insurers, have typically been reluctant to insure. So if you take the United States, for example, there were massive floods in the Mississippi Delta, in the Mississippi Basin in the 1930s, and after that, very few insurers were willing to offer flood insurance. And that prompted, amongst other things, the development of the National Flood Insurance Scheme in the US. Here in New Zealand, as I mentioned, as a result of the earthquakes that occurred in the 1930s and 40s in New Zealand, there was the big Napier earthquake and then earthquakes in the Wairarapa in the 1940s. Insurers were unwilling to insure against earthquake risk. So you had a protection gap in that sense. And what we're facing now is an increasing protection gap in relation to flooding in New Zealand, because the Natural Hazards Commission doesn't cover flooding or coastal inundation. So the gap at the moment is small, but it's bound to get bigger. Okay, and it could get very much bigger if we don't seek ways of mitigating that gap. So the first option is essentially to take a market-based approach, in which we essentially say owners of private property, be they residential properties or business properties, commercial properties, should take responsibility for insuring those properties, and insurers will, in response to changing risk profiles, will adjust their premiums in line with that increasing risk. So you'll get risk related premiums, meaning that if you happen to be living in an area where your property is a relatively high risk, perhaps from landslips or fire or flooding, then you'll be paying a higher premium. And at some point, of course, that will become unaffordable, and at some point the insurer will cease to offer insurance altogether, because the risk of damage will be sufficiently great that it's simply not viable to insure pretty well at any price. Yes?
That's what we have now. Is that right?
Well, this is where we're
Yeah.
moving increasingly.
Yeah.
That's right. So we've got increasing reliance on risk rated premiums. So premiums going up, particularly for those in high risk areas, getting to the point where more and more people can't afford to insure or to fully insure. So you're getting people reducing their insurance coverage. So the property might be worth $1 million, but you're only insuring it for $500,000.
Yeah.
Taking a much bigger excess, instead of an excess of a few $1,000s, maybe an excess of $10,000 or $20,000, and so on. So more and more the risk will be falling on the individual in that situation, if you can get insurance.
If you can. It seems
Yes.
like most of Nelson is in some sort of risk zone.
Well, unfortunately, you have plenty of risks in this part of the world. But much of New Zealand, of course, has significant risk. We're all exposed to seismic risk, with earthquakes or volcanic eruptions. And of course, when it comes to flooding, of course, there is significant variability. There are areas of very high risk, areas of moderate risk, and large areas where there's very little risk of flooding. Just a quick comment, around 500,000 properties in New Zealand are at some risk of flooding. That risk in many cases is very modest. Yeah.
I have a question. Who knows who's not insured? Is there a way of the council knowing?
No, we don't have good data on that, unfortunately, and that's one of the things that would be good to have better data on. Through the Natural Hazards Commission, there is data on the number of residential properties that are covered, and they can calculate there roughly then what proportion of properties are not covered, because in order to get Natural Hazards Commission coverage, you have to have a residential property that is insured. If your residential property isn't insured, then you don't have coverage from the Natural Hazards Commission. And the Natural Hazards Commission, in addition, doesn't cover non-residential properties. Again, unlike the situation in many other jurisdictions where non-residential properties are covered by these protection gap
But the location of them is not known.
It will be known to the Natural Hazards Commission, but it isn't widely known publicly. Yes. And of course, private insurers know which houses or other dwellings that they're insuring, but they don't know which ones aren't insured. So one of the issues is going to be how do we ensure we get better national data over time. Very quickly then, the logic of going down this particular route is that we will link risk to the premiums that people will pay. The logic of that is that people will then be more reluctant to buy properties in high-risk areas. That will drive down the price of the properties in those areas. That means when there is a flood or other damage done from a natural hazard, the economic loss will be less than otherwise because the properties are less valuable. Also, if we take this sort of route, potentially at least the fiscal risks for the government will be less than if it is providing a kind of a backstop. However, that depends, of course, on what governments decide to do. And what we've witnessed in New Zealand time and time again is that after a major disaster happens, governments feel obliged politically to step in and provide assistance. Now, there's a whole raft of arguments against going down this route. One would be the argument that while some people may think linking your premium to your level of risk is fair, others would say, well, there's another view of fairness. And that other view is that what is fair is a situation where everyone can afford to have their properties insured. Because if lots of poorer people can't afford to have their properties insured, then they're obviously going to be more vulnerable to natural hazards. They will then suffer more severely in the event of a natural hazard occurring, or a natural disaster occurring, and you'll increase socioeconomic inequality. Then there's all the problems associated with cognitive bias. This model assumes that people will make rational decisions, but there's a lot of evidence that people do not make rational decisions. People suffer all manner of what are called cognitive biases. Optimism bias, people think things are likely to be better than they might well prove to be. Myopia, in other words, short-term thinking rather than taking a long-term view. Inertia, amnesia, and all manner of things, which help explain why people continue to build and buy in high-risk areas all over the world, notwithstanding the risks. There's a risk in this model that while property prices may adjust, they may adjust very abruptly, which will potentially have damaging economic consequences. This model doesn't address the potential for there to be reinsurance retreat in the long run. We can come back to that if people are interested. As coverage declines, other things being equal, the society will become less resilient economically and socially. And in my view, that would be undesirable. And a key point that should be made is that when we established EQC back 80 years ago, the fact that it didn't cover floods was really a historic accident. had there been massive floods in the 1940s, almost certainly Natural Hazards Commission would have covered floods to some extent. Next slide, I'll be quick about this. So the next option is essentially building on the Natural Hazards Commission and taking a more solidaristic approach. This sort of rests on the foundation that people are going to suffer ever-increasing vulnerability over the coming years because of climate change, and much of that vulnerability is going to be unprecedented. So we're moving into very sort of different times. It rests on the assumption that fairness involves reducing the risk of greater socioeconomic inequality, not just around linking premiums with the level of risk. Assuming you regulate new building developments appropriately, then you can harness both solidaristic approaches with minimizing additional risk. This approach provides an opportunity, and I can explain this in more detail if you're interested, provides a greater opportunity for linking adaptation in the form of relocation with maintaining property insurance coverage, because there's a risk that when it comes to relocation, under a market model, lots of people will lose their coverage well before they are relocated, which means that they will experience many years potentially of not having insurance cover before a relocation process is complete. And I think there's a reasonable likelihood that this approach will reduce overall fiscal risks because it will enhance overall society resilience. Having said that, there's the potential for what's called moral hazard. If people are provided with more affordable and available insurance, there's the risk, if you don't have a good regulatory framework, that there will be more development in areas that are going to be flood prone and so forth. And that would be undesirable because that will increase long-term risk. There's the likelihood that private insurers will resist any move to change the market of insurance significantly, because currently, obviously, private insurance is the primary means of securing flood protection. There's the risk, if you design the scheme badly, you'll get a greater proportion of the benefits going to wealthy owners of coastal properties and desirable river aligned properties and so forth. There's the risk that if you reduce risk, you will, in an overall sense, you will get less political pressure for robust adaptation. And that's certainly evident in the United Kingdom at present under their so-called flood scheme. And if you design the scheme poorly, well then you run the risk of getting significant additional fiscal risk. So both pros and cons. Final sort of slide from me is, this is sort of setting out how we might reform our current arrangements given what's coming at us from the future. So the broad aim is to maintain, if not enhance, economic and societal resilience, to minimize increased inequality by ensuring we have affordable and available insurance for most, if not all, existing property owners. And this could be done by extending the mandate of the Natural Hazards Commission to include flood risk and coastal inundation. If we were to do this, however, we would need to really rethink the current way in which the Natural Hazards Commission operates. So currently what happens is that the Natural Hazards Commission is what's called the first loss insurer. So in the event of a natural disaster like a big earthquake, it takes the loss up to the first $300,000 of a residential property. We don't need to do it that way necessarily. We could have an arrangement in which the Natural Hazards Commission took the full liability in the event of a natural disaster, or that it co-insures, say 50-50 with private insurers, as is the case in some other parts of the world. There's also a number of other elements which aren't necessarily desirable in the current arrangements. For example, NHC provides cover for land damage, but there's no specific charge for or levy for land cover, and we could make an adjustment there. And also under current arrangements, there's no inflation adjustment to the levy. There's also the point that currently the levy is not adequate. The Natural Hazards Commission has indicated to the government that it really needs to double the levy in order to cover future liabilities. So that would mean putting the levy up from, it's capped currently at $480 a year. It would mean putting it up to close to $1,000 a year if you retained a cap. But there's arguably no need to maintain the cap either. In many other jurisdictions, there is no cap. If you have a very valuable property, say $10 million, then you will pay more than someone with a property worth only $500,000 or something like that. There's no necessary logic for a cap. Indeed, having a cap in effect is regressive. It means that lower valued properties are subsidising higher valued properties. So under this model, basically, we would revisit the current policy framework for Natural Hazards Commission, and we would seek to integrate that with a national adaptation plan, which would have stronger regulatory arrangements to prevent development in at-risk areas, and would provide some funding mechanism for relocating properties that prove to be too risky in the light of sea level rise and more severe flooding. So that's a quick summary. I'm sorry, I've probably gone on a bit too long. This is complicated stuff. There's no sort of right answer in my view. There's a range of possibilities. They all have pros and cons, but we really do need to begin the conversation about how we move forward, because the world is changing. We're facing unprecedented risks, and if we fail to respond to those risks appropriately, sensibly, prudently, then we will suffer more severe damage, more severe social consequences than would otherwise be the case.
All
right,
Jonathan,
yes.
You just mentioned there about we need to start the conversation. Is that the stage that we're at in this? I mean, how far away are we from having an operational system of the type that you proposed there on your final slide? Is that within the next several years or decades?
Well, my personal feeling is we need to start that conversation now. And I would have liked our expert working group to have contributed to that. The Helen Clark Foundation has sought to do so through their report late last year. Unfortunately, to be blunt, the current government isn't, how can I put it, wishing to open up the debate in that area to any great extent. And both the Minister of Finance and I'm sure various other ministers, I've spoken directly to the Minister of Finance about this previously, they are more or less wedded to a market model. So they're not really keen to rethink the Natural Hazards Commission and move in a more solidaristic direction. That's a philosophical or ideological position, of course. They're entitled to that. But I think from a political point of view, you realise that, how can I put it? There are probably very few votes in the short run, at least, in opening up a debate in this area. It's a kind of lose-lose. Whatever you do, there are going to be costs and losses and relatively few gains. So from pure sort of electoral considerations or political considerations, this is not a subject that is going to, how can I put it, be one where politicians are going to be extremely keen. But what we need really is a really good piece of policy work by government officials on behalf of the government, opens up the options, opens up a proper public debate, and enables us to have an informed discussion nationally. But I don't think there's much likelihood of that, sorry to say.
I'm sorry, I might interrupt because
Yes.
we're up to the time,
Oh,
but
my.
maybe one more question. I've put my email address there, and so if someone has questions, you feel free to send that
There
to
was
me.
there was a question at the
There was a
front.
question.
Well, I will save some time because that question and your conversation about it was pretty much spot on where I was going to go.
Yes.
Can I just ask a quick one? Just what's the disincentive for me to buy a risky property based on that model, knowing that there is this safety net? Then that I could just spend $1 million on a coastal property, knowing that it'll be insured under this.
Yes, so let's take two different scenarios. First of all, if the property hasn't been developed, it's a piece of land and you're thinking of developing it for residential purposes. Under this model, if you had proper regulation, it wouldn't be developed. So you wouldn't be getting additional risk. Now, of course, that can happen under a market approach as well, with proper regulation. But the question is, will we get that proper regulation? If it's an existing property, then the scenarios are if it's at risk of coastal inundation or more severe, say, riverine flooding or pluvial flooding. What are the sort of range of possibilities there? Under a kind of market-based model, your premium will go up and to the point where you can't afford it, or in fact the insurer ceases to insure, and indeed no insurer will insure. At that point, your property will become a very limited value, because you won't be able to sell it probably, or if you can sell it, it will be at a very low price, because a new buyer won't be able to get insurance either. We could do that. I mean, that's a feasible kind of way forward. But it does mean that lots of people who currently have properties that they bought without considering the implications of climate change are going to be faced with sort of ever-increasing losses going forward. Now, you could say in that scenario, and I'll be brief about this, we could have some sort of relocation process. But if you're operating on a sort of market model, well, how would that get transacted? Probably on a more market model, you'd be saying, well, there's no justification for compensating these people. So how are you then going to get people to move if there's no compensation? Under a solidaristic approach, you would want to combine insuring the property while the risk is such that it's sensible to insure, and then when it doesn't become sensible to insure, relocate. So that would mean buying up the property, enabling the person or people living there to relocate, demolishing the property and removing it, and simply allow the, if you like, nature to take its course. In the expert working group report, just to quickly say, we recommended that there be a compensation scheme, but that it be capped, so there will be a limit on the amount per property. We also recommended that there be distinctions between principal places of residence and second and third homes, on the basis that a key principle must be that we ensure everyone is housed, but there's no responsibility to enable multimillionaires to continue to own multiple properties and have full compensation if one of those, which might be a beach cottage, becomes uninhabitable because of sea level rise. So, two different kind of philosophical approaches, two different kind of policy frameworks. And my own personal view would be that the second is going to be preferable to the first, particularly if we want to minimize inequality, disruption, suffering, and so on. But we could take the first route.
Can I just ask one quick one?
Yeah.
So just following on from that, you talked about compensation. To what extent would some of that fall on ratepayers as opposed to taxpayers?
Well, it would depend how you designed your compensation scheme. We recommended in the expert working group that there probably be several streams of funding for any compensation fund. But probably the bulk of the funding would have to come from general taxes, and that would be relatively equitable, because in the sense that taxation is at least slightly progressive in this country. But we also said there was a case for some kind of levy, which could be on rates, or it could be on insurance, that would contribute to the fund. So in France, for example, they have a Natural Hazards Commission equivalent. It covers all properties in the event of a natural disaster. People pay a levy on their insurance premium to that protection gap entity, but there's an additional levy on the levy which goes to a special fund called the Barnier Fund, after the former Minister for the Environment who established the fund, subsequently Prime Minister. And that fund is used for, amongst other things, buying up properties in the event that it's no longer sensible for people to live in those high-risk areas. So you could combine, you could have a range of funding mechanisms to fund a compensation fund for property buyouts.
If you were sticking to a market-based approach, though, presumably some more of those costs would fall on the ratepayer than otherwise. You wouldn't have that option of taxpayer compensation.
Yes, and it would also mean that if people simply are forced out of their homes after flooding or sea level rise, presumably the local council would then have to bear the cost of demolishing the properties, assuming the people have no money to do that, removing the infrastructure as well. And yes, whereas I think there should be a national fund that would bear the majority of those sorts of costs. In the event that you had a fund and that there were properties that weren't eligible for compensation, you could nonetheless provide some assistance for demolition and removal of the structures. Key point here is that all this really needs to be thought about in an integrated way. Otherwise, you'll have policies sort of pulling in contrary directions, and one can't talk about insurance without thinking about how do we reduce and minimise risk. And one of the ways to reduce and minimise risk with sea level rise, particularly, but also more severe flooding, is going to be relocation.
Which ministry is responsible for getting action in this area?
Well, it's sort of spread across a number of different ministries. The Ministry for the Environment has broad responsibilities for adaptation, but in addition, of course, the Natural Hazards Commission has responsibilities in relation to natural hazards. We have, emergency management. We have the Department of Internal Affairs, which has responsibility for local government issues. And then, of course, there's a range of other ministries, including, of course, the Treasury, which has responsible for overall economic and fiscal policy advice. At the moment, the Treasury, to a lesser extent, the Ministry for Business, Innovation and Employment are leading work on addressing some of the specific issues at the moment that arise because the Natural Hazards Commission is saying it needs a significant increase in its levy. So that is public news. It's under discussion at the moment, and the Treasury will be providing advice to the government on how best to proceed in that regard. But unfortunately, it's not the broader conversation about moving forward that we need.
Oh, I hate to be the one stopping the fascinating conversation, but thank you so much, Jonathan, for giving your time to come and talk to us. And you will be tomorrow evening at Broad Green, I believe.
At Green
Meadows, sorry, at Green Meadows for maybe a bit of a longer talk.
Yes, so specifically tomorrow we're going to be talking about trust, science and climate science.
Oh.
So basic point being, if we have declining trust, social trust, political trust and so on, and trust in science, it's going to be more difficult as a society to reach agreement on the kinds of policy changes we make. Yeah. Because there's going to be more polarization and more divisions of opinion and so on. Yeah. So trust in science is really, really critical if we are to address the kinds of big issues that I've been talking about today.
Yeah. What time is that talk?
5:30, although you might want to get there ahead of time and have a cup of tea.
Okay. And just one more word from me to tie this back to the strategy quickly. So what Jonathan's talked about and the direct impact, they all sit under one specific pillar, which is the resilience of our built environment. But if we look at the broader impacts, and we were talking about the transboundary risk, things that come from overseas, at the end of the day, they sit under the whole strategy. So really, it is a resilience strategy as well as a mitigation strategy. So I invite you to look through it and try and see where that comes through. And also, so Council is going through an adaptation plan. We have done the regional climate change risk assessment and just received the final draft, so we will review and then it will be made available to the community at some point. keeping in mind that it's the first one, so it's high level. But as we move on to the next step, which we are preparing now, which is working with communities that are at risk to draft some adaptation plans, then we will dig it a bit deeper into the risk assessment and get that awareness. So we very much look forward to getting started with this work, which should be, fingers crossed, this year. We should be starting with at least one community who is most at risk. Thank you very much.